When it comes to understanding your credit score, managing credit utilization responsibly are essential for your financial well-being. If your score is low, you will pay more things for your entire life without having that payment history. So in today's video, guys, we're going to be defining the credit score, breaking it down, the things that really do affect it. Also talk about a couple of detailed points on what you can do to really make sure that your credit score stays up. That way you are approved for loans and you are paying as little interest as possible during the life of that loan. So number one, guys, the definition of a credit score. It is a 3-digit representation of the individual's assessment, creditworthiness to repay a loan. So this could be a mortgage, this could be a credit card, this could be an unsecured loan, it could be an auto loan, it could be anything. It gives you a number essentially that is assigned to you. That is the likeliness and the likelihood of you to repay anything that is borrowed based on previous history. Now this does get a little bit tricky when it comes to someone who doesn't have a credit score or has damaged credit, poor credit, no credit, because the score will either be much lower or there will not be a score at all, which means you can find a lot of very cheap ways that we're going to be talking about in the future, guys, to rebuild that credit score or actually establish credit. That way you can get a lower rate for your loan. Up front, it might cost you a little bit more to rebuild. It might cost you a little bit more to establish credit. But overall, there are a lot of programs that are relatively cheap or inexpensive that you can start building the credit score. Now, number two, the numeric range. Credit scores typically go from 300 to 850. That is right. In 16 years of being in financial institutions, I have not seen an 850 credit score. I don't even know if it's possible. Theoretically, that is where it caps, guys. 820, 830 is the highest that I've seen. The higher the credit score, it indicates better credit worthiness. Lower score suggests a high risk to lenders. Now, again, if you have a lower credit score, the chances of you getting approved are much lower based on your credit history, which is the reason why you have to monitor it and you have to check it on a regular basis. There are credit cards, there are banks, there are credit unions, there are a ton of places that will monitor your credit. When you think of like Credit Karma, that will do it for absolutely free, guys. This way you know where your score is at before you go to apply for a loan, before you apply for a mortgage, things of that nature. You know exactly where your score is or kind of a general idea. Now, the problem that we see with Credit Karma and a few other of these that kind of track your credit score is a lot of times it's not accurate. It might be 20, 30, 40 points off. However, knowing that you're paying your items on time, you're keeping the ratios of your credit cards down low, you will have the ability to borrow and you will be approved when you are borrowing. Now, calculation method. Now, the calculation in the credit scores are based on the information that is housed within the credit reports. This is the reason why freecreditreport.com is a vital tool, guys. You have to go in there and you have to make sure that everything on your credit report is accurate. That is the big important thing, guys. If there are things on your credit report that shouldn't be there, inaccurate amounts, closed accounts that are reporting, open accounts that were not yours, you have to make sure you're responsible for your credit, cleaning it up and making sure that everything is correct in there. Now, what does make up the credit score itself? There are 5 different buckets. Number one being the payment history. Payment history, of course, is the biggest piece of your credit score. Credit utilization, meaning the amount you have available to borrow in relationship that you have borrowed. This, again, is going to make a big difference. This is another 30% of your score. So between the payment history, the credit utilization, you are looking at 65% of your score right there, guys. That is the bulk of it all. If you make your payments on time, if you keep your utilization low, you will have a good credit. Length of credit history. This is one, guys, that just takes time. This, again, is something that overall it is going to take a multitude of years to really build up the length of credit or your credit history. So if you look back in, let's say, the last 12, 24, 36 months, you have had everything paid on time, you will have a decent score. Regardless of some of the utilization, even if it is a little bit high, the score will still be relatively high in the BC range, I would say, at that point. Next part we look at, guys, is the types of credit. And then, of course, the acquiring of the new credit are the final 2 components that does comprise your credit score. Each factor does carry a different weight in calculation of your score. But again, big things to remember, guys, the payment history, the credit utilization are the 2 biggest factors when it comes to the credit score. Number 5, we get into the credit risk assessment. This is what lenders use to assess the credit risk or, again, the ability for the individual to repay a loan. If you've repaid loans and you've always been on time with payments in the past, There is nothing that says that you're not going to pay them or you are going to pay them in the future, guys. So they are making lending decisions on the past performance of your credit, which of course yields you a score to make informed decisions. And there are also a lot of guidelines that institutions have to follow for loan approvals and setting interest rates, guys. So again, the difference between, let's say, having A plus credit with an auto loan, A plus credit, you might be at 6%. If you're running at D or E credit, which is about a 590 or less, you might be looking at a 15 to 20% difference in your rate that you are going to get for a loan, guys, which again, astronomically speaking, looking longevity wise, you need to improve your credit score. You need to get the payments down for cheaper. They are making more money off of you at financial institutions because you do not have good credit. Now, credit score frequency. This is something, guys, again, a lot of credit monitoring services are out there that are absolutely free. Credit scores in this can report. Now, credit score frequency as well. You have to make sure that you have utilization with the credit score. I know a lot of people like Dave Ramsey, say pay cash for a lot of things, stay out of debt, do not use credit cards, always use your debit card. For most of us, that is not there isn't an ability with that, guys, because when you go to make a larger purchase, whether it is a home, whether it is a car, if you do not have credit and you're not utilizing any of your credit, you will have no score and then no history in turn, meaning that lenders are going to charge you a lot more, or the lender just might not approve you at all because you don't have credit history. Now, what I advise, guys, is if you don't have a mortgage, you don't have an auto loan, carrying at least 1 or 2 credit cards and carrying them at a zero balance. So the credit report looks for really 2 different things, guys. 1, did you make a purchase on the card? 2, did you make a payment on the card? That's it. So what we advise for a lot of younger individuals or even rebuilding credit scores is, let's say you have a credit card, you're going to utilize that credit card for gas and gas alone. So anytime you need gas for your vehicle, you are utilizing that card specifically to only put gas in your vehicle. Every 2 weeks when you get paid, every month when you get the bill, you're paying it off in full. Again, building up that credit history, keeping the capacity of that card at 100%, meaning you are not carrying a balance on that card. Now, credit score impacts. Major life events, taking out a loan, applying for credit will influence your score. Now, depending on how strong of a score you have, it'll have a little bit of impact if you have well-established credit. If you have almost no credit, it can have a significant impact because, again, they're basing it on the credit that you do have. Late payments, defaults have a massive negative impact, guys. Essentially, if you're late one single time for 30 days, so if you're paying your bill and you are more than 30 days late, that can wipe out 24 months of on-time payment history. When it comes to your credit report, that can absolutely wreck it, especially if you are a younger individual that is either establishing credit for the first time or an individual that is repairing or rebuilding credit. One missed payment, guys, that is the reason why we talk about the automation, making sure that you are using the automation and payments, at least the bare minimum payments on everything are set up. That way you know that it is paid in full. Now, understanding this credit score ranges, they go from excellent, good, fair, poor, and bad. Now, this essentially can also be signed a letter. So excellent will be A. Either the B tier or the A minus tier can be good. And then C for fair, D for poor, and then E for bad is usually them. This is where they do the determination of what your rate is going to be. Like I said earlier, if you're at an A or an excellent credit, you're going to get a 6% for a loan. If you're at, let's say, a poor or you're at a C credit, chances are you're going to get probably a 10 or a 12. If you're bad credit, it could be 15 to 20%. Again, making the utilization, you have to improve your credit, guys. Now, credit score importance goes beyond loans. This, again, is a pivotal point, guys. If you're looking at your credit score, job applications, rental applications, insurance rates, most places do utilize a credit report to know exactly what kind of person or what, if you have good credit, if you have poor credit, depending what your financial life looks like. Now, there have been studies that correlate credit scores, the ability to repayment, the financial life, the financial aspects into the workplace with, job tardiness, job absenteeism. There's a lot of things that they have kind of correlated through time, which is the reason why a lot of job interviews or job applications will have a consent to pull your credit. Rental applications, the exact same thing. So if you go to rent a place or if you do go to get an apartment, they will pull your credit, knowing exactly where you are. And if you live in Michigan like I do, the insurance rates are based on credit, guys. If your credit score goes down, your insurance rate will go up, and it will go up considerably. The credit score improvement strategies, there are a couple ways that you can improve your credit score, which we're going to get into in the next couple videos. But paying your bills on time, again, are the biggest one. Reducing and eliminating your debt, as well as disputing anything that is inaccurate on your credit report. Guys, you have to make sure everything on there is yours and yours only. So guys, that'll do it for the basics for our credit scores. Let me know in the comments what you guys think, and I'll catch you in the next video.